Okay, good morning, everybody, and welcome to the Daily Energy Markets podcast. It is April 17th, Monday morning, 10:30 UAE time, and Brent crude oil is opening in Asia today, essentially little changed, bouncing around a few cents. Let's kick off with our regular Monday morning commentator, Omar Najia, Global Head of Derivatives at BB Energy. Omar, it feels like a market looking for direction. What will give this market its essence, its next direction? I mean, all said and done, we've been stuck at $85 Brent for most of the year. Few sort of moments with the banking crisis, but otherwise it's all been $85 Brent. What's going to give this market some new direction?
Well, I mean, if you look at the market in the last 2, 3 weeks, basically, we set a low around 64 WTIs, whatever it was on Brent, $70 or so. And then basically the action of that low has been very emphatic. And after about a week of basically price moving straight up, OPEC came and said that they're going to cut production, and that set the price even higher. So I think the market has all it needs. I don't think it needs constant feeding of, here we go, you got to go higher, you got to go higher. I think it's going to do that on its own. So I think the market, I mean, it depends because if you look at all the news that's come out, first it was like, China, and then it was, well, maybe not. And then last week, it was more about, the EIA was saying, and will it really, and all this, right? So the answer to everything is yes. The price is going to go up. The path of least resistance is up. I think basically the fact that the EU has this cap on Urals at 60 and a cap on products at whatever it is, $45 a barrel is going to be extremely interesting. I think basically there's what I term kind of free money. If you push the price way past that, I think people are going to start to panic because they're going to have to start to decide in the West if they're going to pay these prices, or they're basically going to end up with no fuel at all. It's also interesting that Germany's stopping its nuclear-powered stuff. I mean, you couldn't write a better story for higher oil prices and the fact that everybody's so convinced that, everything is going to be okay and nothing's going to, and OPEC might or might not cut again. And, I think basically they've taken a strategic decision. I think the decision of Russia to cut 500,000 before OPEC decided to cut its 1 million is something that was coordinated. I think basically that Saudi Arabia is moving out of the US orbit. I think that the EU is, et cetera, et cetera, et cetera, et cetera. So nothing has changed. I think, as I was saying last week, and I think the week before that, we're now looking quite, higher in terms of the price of Brent, the price of products, and so on and so forth, higher.
Jamie Ingram, senior editor of Middle East Economic Survey. Do you concur with that, Jamie? I mean, it seems that despite the sort of optimism from the beginning of the year that China would deliver, it's been of a limp recovery. There's no shortage of oil in the world, it would appear. Where will this higher momentum come from? As I said earlier, it seems we've been stuck in and around $85 Brent for months now.
Yeah, good morning, Sean. Great to be here again. Yeah, as you say, China's a big unknown in this. There's bulls, there's bears on that case. Obviously, the key downside risk at the moment, it's gone away from the headlines a little bit, but we're still got this issue of potential banking crisis on the horizon. It hasn't been an immediate contagion from the Credit Suisse fallout, but there's still gremlins lurking in the machine there. Who knows what's going to happen if it looks like the Fed is expected to increase interest rates again, so that's going to put more stress into the system. There could be more banks suffering from that as a result. We're seeing diesel demand not kicking up to where people were expecting it to be. That's always a little bit of a bellwether of the global economy there. So the IEA is actually expecting diesel demand to fall this year, I believe. That's not the norm, especially when you're coming out from a low demand period. So yeah, there's still alarms there on the global economy and what the impact of that's going to be on oil demand and ultimately on oil prices.
the situation vis-a-vis where we're going on the storage, floating storage, are not necessarily intended to be floating storage, but nonetheless, there is a lot of floating storage as a result of the longer trips. Matthew Wright, senior freight analyst at Kepler, what role is that playing in essence, a kind of a downward pressure on prices? Because some calculations would say there's over 1 billion barrels of oil or some significant large number of oil in some element of floating storage.
Yeah, good morning. Thanks very much. I don't think it's floating storage. I think it's crude on water, and as a result, I don't think it's having an impact on price. These are cargoes that are all going places. They're just traveling further than they ever have done before. So generally speaking, there's no distressed cargoes. There's not really any market structure incentive to store crude. So it's all going somewhere. It's just, we're taking up a lot of ships to move a lot of oil at the moment.
And where is that being reflected? I mean, is there a technical definition of where floating storage separates from taking a longer time to get somewhere? I mean, ultimately, it's a lot of oil, right? That is moving slowly, but ultimately, the supply is plentiful.
Yeah, absolutely. So there's different definitions of floating storage. Some people say, anything over 7 days, but you have to have a vessel that's essentially idled. So, at Kepler, we have an algorithm that will work that out for us. And floating storage is not really on the rise. But as you said, actual crude on water, it's at sort of near record highs. And a lot of that is to do with Russia. So the changes in terms of destinations of Russia's customers has changed massively in the last year. I think we've almost reached a peak with how much more we can see Russia ship to India and China. It's pretty much maxed out. There's almost nothing going into some of the shorter haul destinations. So there's potentially a little bit of increase from Russia, but not a huge amount. But some of the other factors that have pushed crude on water to record highs is the US and actually the Middle East as well. So a lot of US crude went to Asia over March and into April. So that's had a big impact, lifting the amount of just volume on water. But also the Middle East, we saw a lot of Saudi crude come out in the last month or two. So that's helped. That's definitely helped push that up. Lifting tanker demand. Their freight rates have been exceptionally high for over a year now. There's a lot of volatility, but they're sort of holding at pretty high levels. We're still hugely above all pre-invasion levels in terms of freight rates.
Omar, I mean, last week was defined primarily, at least from a headlines point of view, the IMF, World Bank meetings in Washington. Generally, the narrative combined with economic forecasts out of the US, but also less sort of, somewhat dampening outlook from China as well. But ultimately, the World Bank, IMF forecasts were for global growth to be sluggish to declining. How does that coexist with a higher sort of progressively higher climb in oil prices, while the global economy, according to the IMF and the World Bank, is going in the other direction? From your analysis, how do those two things coexist going forward?
I mean, that's a really interesting question. But just to go back on storage, if the market is backwardated, there is no storage by definition. Nobody stores, or you lose money. So unless you want to lose money, nobody's storing anything. On the question about the coexistence, that's something that I think about a lot. So basically, these forecasts. I mean, if anytime I look at something to do with the S&P or something to do with equities in Europe, they look really unbelievably bearish. In other words, they look like they need to kind of collapse. But I mean, like 30-40%. They really do look terrible. On the other hand,
what needs to collapse? 30-40%?
Equity prices. Look at the biggest market out there, which is the S&P, right? So I think the S&P needs to really come off. Then you look basically at crude, and crude is giving you the opposite picture. Same if you look at copper. So, as in we've had, that heating oil or distillates is supposed to be an indicator of, market or economic strength. You look at copper. Copper looks to me like it wants to head substantially higher. You look at oil. Oil looks like it wants to go substantially higher. Then you look at equities, and equities look like they want to go substantially lower. Now, at the end of the day, things can be correlated. It depends on what kind of, day, week, month. Sometimes they move together. Look at, for example, Bitcoin and Nasdaq, and then at some point they kind of, diverge. So I don't know what the real world explanation is going to be, but why oil should rise and equities should fall, honestly, I don't know. But I think there's a first time for everything. Maybe this is it. So
we're certainly seeing a lot of firsts, no doubt about that, and counterintuitive outcomes that we haven't seen before. Jamie, we still have some old-fashioned tangible realities, of course, and that is supply and demand, inventories. Just starting with the situation in Iraq, in Kurdistan, the exports of Kurdish oil, which was meant to restart to Turkey, now looks like it might be sort of stuck for a while, as Turkey and Iraq, Baghdad and Ankara cannot find agreement on restarting, on implementing the decision by the International Arbitration Court in Paris.
Yeah, absolutely, Sean. That's an interesting one. I mean, Turkey kind of blindsided a lot of observers by implementing the original court ruling so quickly. Nobody expected them to suddenly say, yeah, we're going to turn this pipeline off, when they did. And then that kind of pushed Iraq and the KRG together, right? Okay, we both need this pipeline operational. We need to come to an agreement so that we can get Turkey to turn this thing back on again. They came to an agreement quicker than, again, most people expected them to. And suddenly Turkey's like, hang on, we're not actually going to open this pipeline now. We did have our own other reasons why we took this action in the first place. So at the moment, Turkey is basically holding back because they're worried that Iraq, so the original ICC ruling was for a period where Turkey owes Iraq damages from 2014 to 2018. There's clearly the potential for damages from 2018 and beyond, and that will be in a future court ruling potentially. So Turkey wants Iraq to take that off the table. So they're saying, we'll open this pipeline, but we want guarantees that you will not come at us for future damages for enabling KRG exports. There's also issues about water rights, these kind of long-standing geopolitical issues about the Tigris and Euphrates rivers that's stretched down from Turkey into Iraq. So these issues are kind of all being bundled together, and that's why we've got this geopolitical issue that is taking about 400,000 to 500,000 barrels a day of crude oil exports from northern Iraq off the table. That's something that effectively I think we're not going to see much movement on the surface until bang, we've got an agreement signed and sealed. But there's massive uncertainty over how long this could stretch on for. Turkey doesn't have a huge incentive at the moment to play nicely.
Where does it, just Jamie, following up on that, does it intersect with the committed output cuts that are to come into effect from OPEC Plus on May 1st? Of course, Iraq has committed to be part of that, I think 150,000 barrels or something.
Yeah, it's somewhere in that range of 150, 200,000. I'm not sure off the top of my head exactly. I mean, certainly for as far as Iraq is concerned, if should the pipeline come back on in mid-May, well, they're going to pump at full capacity because they're going to say, well, we have to offset this involuntary cut that was going on beforehand. And quite frankly, they're probably going to play that card anyway as it is. There's also clearly the fact that these are voluntary cuts, so enforcement mechanisms are not quite as strong as they would be for fully mandated OPEC Plus cuts. So again, Iraq's not going to come under quite so much political pressure from the likes of Saudi Arabia if it doesn't quite fulfill its promises. And yeah, this Turkey issue is certainly something that they're going to use as a card to reduce the level of their cuts at as far as they can, especially if prices are juicy and there's a big incentive for them to maximize production wherever possible.
Matthew, it was the question I asked Omar there about how can we have the coexistence of these two things, the declining economic outlook and an upward motion in oil prices? I suppose if you cut supply enough, you'll always get some upward motion. But are we seeing that divergence also in the shipping, where on the container side, in terms of the biggest routes, China to America, for example, big declines in container rates, but yet in tanker rates, we're still seeing elevated. What's your analysis there on that divergence?
Yeah, I mean they're separate classes, and we've got separate supply demand fundamentals. But you hit it on the head. I think what we're seeing in crude is independent of the crude price, but we're seeing the market being stretched. That it's incredibly tight supply of vessels, and it's set to be for the foreseeable. There's not enough deliveries to keep pace with the amount of demand. And just in terms of the price action we're seeing at the moment, just the point you were making about KBT and the crude coming out of Turkey, we're essentially, the loss to Iraqi production is not that far off what the sort of intended cuts are going to be. So we're at a tightness now that is essentially going to be in place and through the rest of the year. And with China coming back, we've got loosening monetary policy, we've got improved mobility. We're going to see the summer should be sort of the tightest period, really, in terms of price. And we're not as bullish as some in the market, but we definitely think crude could rise slightly from where we are at the moment. And that actually does raise a bit of an issue for Russia, because if crude goes above $90 a barrel, it becomes less and less believable that any of the EU or the Greek tankers can continue lifting Russian crude and claiming that this is below the price cap. So then we're going to see a big swing in sort of the vessels that are handling Russian crude. So that $90 a barrel sort of line is a bit of an important benchmark, because if we start seeing that, the Greeks are going to have to start doing other business.
Why is that? Because it would be violating the laws as set by the G7 and the European Union?
Yeah, absolutely. So under the price cap rules and the G7 sanctions, any EU-owned vessel and insured is not allowed to lift any Russian crude above the price cap. And at the moment, since the caps came into effect, we've had quite a stable crude price environment that has essentially allowed flows to continue. There's been some change. We've got this sort of grey shadow fleet that have come in, and they're lifting a lot more. These are vessels owned from India, China, Hong Kong, UAE, etc. But the Greeks have maintained quite a large share. It dropped off and it's come back up. But should we go above 90, I would think that would drop away quite a lot. The Greeks would have to go elsewhere to find business, depressing markets. And then we would have this grey fleet move back in and increase its share, which comes with its own risks.
Let's go to the survey question, which is tackling the kind of headline of the morning discussion is, will Brent crude oil hit $90 or $80 first or next, whatever way you want to see that? We've come above 80 with the surge of the OPEC plus cut. But we haven't quite sustained the momentum. We've got back to that kind of mid-80s range, as noted. But will Brent crude oil hit $90 or $80 next first? Your thoughts on that? Omar, we're looking at now coming sort of the next sort of big monetary policy headline, the next round of central bank rate rises and so forth, the big expectation that the Fed will continue to raise rates. Others may or may not follow in terms of the ECB or the Bank of England, etc. But your thoughts on the intersection and relevance of that or not vis-a-vis the direction of travel for the oil markets?
Okay, so that's a good. If you go back to the last question, which is, how do you reconcile crude oil up and S&P lower. What if basically what if the Fed raises rates, which they're going to do, which is not going to make a difference in inflation because they've already flooded the market with more dollars because of the banking crisis. So they haven't really withdrawn any dollars from the market. They're back to where they started before they started raising interest rates. Meanwhile, interest rates are very high, which makes basically their debt payments unsustainable without printing even more dollars because they don't really pay for that. They can just print it, whereas every other country has to actually earn the money to pay for their dollars. So bottom line is, what if we have runaway inflation? What if it comes as a shock to many that raising interest rates to 5.5%, 6% doesn't really dent it when consumer prices are up 10%, or even if inflation in terms of factory price inflation is 15, 18, 20, whatever it is. What if it doesn't make a difference? What if basically the fact that they keep printing money just makes everything go haywire? In that case, you have inflation, you have oil skyrocket, and you have basically equities dump. And why is that? Because basically treasuries keep going higher. You can buy treasuries and at whatever 5, 6, 7, 8%, and so companies in the S&P to attract investor money because they entail risk, because the price of Apple or Amazon or whatever it is can go up as well as down. So instead of needing to make 6% the treasury rate, they need to make 12 or 18% in terms of returns. So that's something to keep in mind. If we do start to see runaway inflation, it's going to get very interesting. I think what Matt was also saying about the Greeks and the ship owners and all the rest of it. What's going to happen? I mean, we have a high conviction that oil is going to go considerably higher. So I think $90, $100 plus on WTI, let alone Brent. So it's going to be very interesting to see what happens. I mean, whether sanctions, basically everybody forgets about them, nobody talks about them. I don't know what's going to happen. And in the winter, I think it's going to get even worse. So it's going to get very interesting.
Jamie, I wanted to get your thoughts on the OPEC Plus decision. There's been a lot of analysis around it being a sort of a message of departure from its strategic geopolitical departure, or is it simply a supply-demand call that the market outlook is bearish, even though OPEC Plus maintained last week its forecast for 2023? Those two things seemed incongruous. The idea that we're going to cut supply, but yet our forecasts are remaining the same, i.e. a fairly bullish outlook for demand recovery in the second half.
Yeah, there's definitely a disconnect there between the actions of this cohort within OPEC Plus that decided to implement voluntary cuts and the actual analysis that's being put out there by the OPEC Secretariat in its monthly reports at the moment. I think that essentially the way that the main section of the OPEC report read was, we see prices going higher, and then, oh, by the way, lots of guys decided to implement voluntary cuts and there's a big downside risk, which is why this is appropriate. It was kind of here's the analysis of why price is going to go higher, but here's the excuse as to why actually this was a great decision. But yeah, as to why they did it, yeah, they were definitely, there was clearly an element of pricing in there. I mean, the Russian spokesman, although Russia's cut is separate, he said that this is supportive of prices, and that's one of the key reasons. So that kind of let the cat out of the bag on that one. Whether the floor that they want is 75, 80, maybe 85 is neither here nor there, but clearly there is a price level that they are setting their hat on defending, and that was a key contributor here. There was an element as well, I think, with regards to the US SPR. They were given assurances that the US was going to start refilling at a certain price level. Then the US government came out and said, actually, this is really technically challenging. And so despite what we said, we're not going to be doing that. They've kind of reversed ferrets on that again now, the US, and said that they are going to start refilling the SPR again. But frankly, I think we're now in you have to see it to believe it kind of territory with that. Even if they have the intentions to do it this time around, are they technically capable of it? I don't know. I doubt many people in Riyadh want to gamble on that. So they're not going to be taking US statements like that into their supply demand calculations, I think. But clearly, if the US does come back and starts buying up to fill the SPR, then that's another demand source, which is going to come into play later on in this year.
I just wanted to follow up, Jamie. I know you guys at Meese do track quite closely the direction of travel for oil products coming out of the Gulf, and most recently the situation with the Al Zour refinery in Kuwait. If you might just give us a quick update there, what that might mean for crude exports, given if the refinery's in trouble.
Yeah, so the Kuwaitis are trying to downplay the extent of the seriousness here. It's it's fairly normal that when you have a massive new refinery being brought online, there are going to be teething problems. So nobody needs to panic about Al Zour being down at the moment. But when they say 2 weeks is how long it's going to take to bring it fully back up to where it was beforehand, with 2 CDUs running at pretty decent capacity, I think it's fair to use an element of reasonable doubt on this. It might take a month, it might take six weeks, 2 months. And clearly that is going, this is, let's say they were running about 400,000 barrels a day through that refinery. That's volumes that are now going to be exported directly as crude, instead of being sent to this refinery and then exported as products. And interestingly, for a modern refinery, Al Zour was designed to have a very high fuel oil cut. So that's going to have an impact on very low sulfur fuel markets. It was primarily shipping out to Singapore on that, but it was starting to head into Fujairah, so that'll have a bit of an impact on regional markets. And then middle distillates, a lot of it was heading to Africa, actually heading into Djibouti. So we'll see what happens with those trade flows now as well.
And what about flows into Europe? The oil products that were seeming to increase in their direction towards Europe, given the embargo against Russian products?
Yeah, I mean, most of that was coming from Kuwait's legacy Mina Al Madi, Mina Abdullah refineries, but clearly some of that might now be diverted to where Al Zour was going. So it's all going to be up in the air as to exactly how those trade flows do coalesce, but theoretically it shouldn't have too much of an impact on Europe.
Okay, Matt, last word with you with the survey result, which is kind of overwhelmingly in favor of 90 rather than 80. But I have to admit, I'm an 80 man myself. But your thoughts on where is you started out your comments this morning that there's a lot of stress on the availability of tankers, given the longer distances of over 1 billion barrel, 1.2 billion barrels en route and longer distance, however way you want to characterize that, oil on water. What is the outlook for that easing, or does that stress just magnify when these cuts start to happen by OPEC plus?
It shouldn't get worse. When we got cuts, you essentially have a drop in demand. But what we might see is, if we see a cut from the Middle East, we might see more supply, more exports from the US. So a lot of this really will depend on what China does. How much, I think March was one of the highest months for Chinese crude imports. So if we see China continue to buy firmly over spring, summer, it could actually be very positive for tanker demand, because we could see barrels coming from the Atlantic basin all the way to Asia. So as with everything, China sort of holds the keys to what's going to happen, I think, over the next couple of months.
Well, we'll certainly have to keep a close eye on it, but I think increasingly the eyes also have to be on where is the demand centers or the consumption in Europe and the US, because ultimately the Chinese have to sell their Barbie dolls to somebody. And if little Susie in Oklahoma isn't buying Barbie dolls this Christmas, the factory manufacturing out of China slows down, and that seems to be the general narrative at the moment. Less trucks on the roads in China, less manufacturing, even though there is reporting of an upswing in consumption from the global south. The trend of traffic in the G7 economies has to be a major indicator as to whether Brent crude oil can break higher or lower. We will wait to see. But as always, Omar Najia, great to have you on Monday mornings. Jamie Ingram, thank you so much. Getting up hopefully not as early as before in London with that hour change, and looks like you're getting some nice sunlight already this morning. Matt as well, thank you so much for joining us. Have a great day, everybody. We're here every morning at 10:30 UAE time, and as we started, Brent is little change this morning at about $86 a barrel. Thank you.
Thank you.
Thank you.
Cheers.
Bye.